representative of TEKLAS Ventures, which is a venture capitalist. Owen focuses on automation, robotics, and the whole automotive industry 4.0. What was 3.0?
Not as fast.
Not as fast. He also specializes in energy and decarbonization. Previously, Owen led investments at Expon Capital in various companies. I won't list them all now because there were too many. You've been too busy. Ladies and gentlemen, can I present to you Mr. Owen Reynolds.
Thanks so much. Good afternoon, everyone, and thank you for the very warm introduction. Today, we're going to be talking about one of the hot topics today that got kicked off this morning, and is one that I have spent a lot of time thinking about, for better or for worse. It is the divergence of the EU and US economy. Now, to be clear, the divergence that we've been talking about and has been popularized by the Draghi report is not just a story of the EU versus the US. This is really the US pulling ahead of the rest of the markets, private markets, public markets, you name it. They've decoupled entirely from their closest trading partner, Canada, for the closest trading partner for 200 years. And it impacts not only the public markets, of course, but private markets as well. Over the next 15 minutes, I'll be talking about 7 key areas that I think define this. And they are not the Draghi report. I am not a policymaker. I'm an investor, and I care about what the rules on the ground are today. But I do want to emphasize that several of the structural issues have set up a focus in the US on not the median, not the average, not the normal, but the exception and the exceptional. A lot of people can go back to culture. I won't start there, but I'll fill in the area between culture and the Draghi report. Point number 1, though, is background, which includes some cultural elements. But there's a couple key parts that start very early in life. One is, of course, education. I can testify that as being an American educated in America and having children being educated in Europe, that there are various differences. But there are 3 different functions from a socioeconomic perspective for education. Education itself, indoctrination, you have to make sure people fit in, and filtering. Now, these are gross exaggerations across the next 15 minutes. One of them is that in the US, there is a tendency towards a certain amount of freedom in the educational path. There is a big filter mechanism at 18 years old. You have to pay $25,000 to $50,000 per year to go to university. So if you think you are good enough to pay it back and double it, then you should go for it. In Europe, fortunately for parents of European children, there is no such filter mechanism. If you want to go to school, if you think you're smart enough, you can try. What happens is that the US education system is set up to find those exceptional people and to curate them. There are programs such as the Montessori School, which have succeeded and have become a bedrock of Silicon Valley. Founders from Google, Facebook, Wikipedia have all come out of that Montessori ecosystem that focuses on children learning to educate themselves and love education as a lifelong passion. Now, I'm not saying that educators in Europe are not doing that, but they are also burdened with having to find children that will fit in the right place at the right time, a filter mechanism. At the next stage of education, there's one part that, of course, impacts a lot of us, MBAs. I have an MBA, and I will tell you, for the most part, it is not helpful. But there is one very important thing that MBAs teach all students. For 2 years, you are told day in and day out to hire up, never to hire below you. Only hire people that are smarter, better, faster, and more talented. This is not a natural thing. Nobody wants to hire people that could take their job, but that is what you are trained to do. That is the only function that I think MBAs have that sets them up for success and set the corporates up for success that they work with. Now, there are a lot of downsides to both of those things. The last from the background, though, that I'll mention is case law. American and the UK still rely on a case law system. So not a strict Napoleonic law. That means every single business decision is a negotiation, or a negotiation waiting to happen. It means there's always gray area, which reemphasizes that focus on creativity, lifelong learning, and looking for the exception to get out of those sorts of tough situations. Point number 2 is what I call the dollar reserve discrepancy. This isn't something you'll see in a textbook, but it's the marriage of two topics that are familiar. One is that the US dollar, for better or for worse, is and probably will remain the natural reserve currency of most global central banks. By having USD in reserves across central banks of the world, it levers up the USD by ever so slightly, devaluing national currencies. Now hold that picture in your head, and just to make sure that you know how big of an impact this is, 58.9% of all of the world's reserves are held in USD, or US dollar denominated bonds more specifically. That is $6.7 trillion. That reminds you, if you have an economics background, of another economics term called the Dutch disease. Now, excuse me to my Dutch friends in the room. The Economist, after calling it this years back, went and called it the paradox of plenty, which I think is probably a nicer term. But it goes back to, in 1959, there were massive natural gas reserves found off the coast of the Netherlands. Throughout the 1960s and 70s, those were exploited, and it was a bonanza from an outside perspective. GDP boomed. However, it was at the detriment of the manufacturing sector. By also ever so slightly leveraging up the value of the florin, it ended up destroying the competitiveness of the manufacturing sector. The two things that happened here are similar. A currency being increased over valuation. Now, currency is just the productivity of a national population divided by the amount of currency in circulation. However, by ratcheting this up, you're giving it an unnatural value that has to be matched by labor productivity. In the case of the Netherlands in the 1960s and 70s, this was met by uber-productive gas and petroleum reserves. In the US, there was a labor vacuum, and that filled into uber-productive economic output. So tech, biotech, high-tech manufacturing, all of that became the only thing that could be produced in the US. So there's no policy answer for this. It's just part of the economic underlying underpins. Point number 3 is monetary premium and investments. The top 10 US companies invest 3 times more in R&D than the top 10 European companies. And that's not necessarily made up by the tail, unfortunately. Why does that happen? You often see a chart, where it is, like this, that shows all of the countries stacked up with Germany, France, UK, Italy, all of Europe saving higher. This is a savings rate as a percentage of GDP. And then the US being at a lower savings rate. And of course, you think, okay, lower savings, more of that capital is being invested. I'd rather show another chart, though, which is not a percentage of GDP, but rather savings is a percentage of disposable income. So how much savings do I have as a percentage of what I can save, not a percentage of what the manufacturers and the tech companies are worth. This is actually quite consistent across the OECD. You can see most of the countries somewhere between 10 and 18%, with a couple outliers, including our home here in Luxembourg. And theoretically, according to normal macroeconomics, you'd think that savings more or less equals investment. Well, we all know that's wrong. And here's 2 big reasons in the US why that isn't the case. The quality of savings, the quality of investment is led towards capital markets. The 401k and the IRA are 2 institutions that were developed 40 or 50 years ago in the US each that funnel capital from private savers directly into markets. I can tell you from having one, it is so easy to have a target date fund, an index fund, public equities, public debt, and now increasingly private equities and alternative assets. This you can do from a dashboard, and every family has one, which means that every investor in America knows that this capital will be flooding the markets, not just this year, but in perpetuity. That has created an 87% premium. One analyst estimated that the mid-cap, so forget about the big tech stocks. Let's go to the mid-cap. One analyst estimated that the mid-cap measured by price to earnings growth in the US was trading at 2.8x as opposed to 1.5x in Europe. That is an 87% premium. This is probably more exacerbated at the higher ends. The next point number 4, is exits and liquidity. Now, the Draghi report does talk about this, so I won't belabor the point. We all know that the 2 major markets in the US, the New York Stock Exchange and the NASDAQ, make up the lion's share of exit potential. They are 42.5% of the equities markets, as opposed to, of equities markets, compared to 11.1% of the EU. Now, I work at leading investments into VC and VC-backed companies and VC funds, and I can tell you that every founder thinks about this chart when they found a company, think about how to liquidate a company, and how to build a company. Point number 5 is structured failure. This is a tricky one, and I'm very happy that our colleagues from Invest Europe earlier talked about how unlikely it is to change insolvency law. America is designed to cycle through companies and talent very quickly. Well, I don't expect that to happen on European shores very soon. I will give a little story. I was looking at a company whose runway was shortened significantly more than we thought. And we thought about how to save the company. We thought about, all right, let's cut headcount. To save 3 months of runway, it cost us 3 months of headcount runway. So there was no way to win. The company, had we not found other ways, would have been default dead. In venture capital, when you get short of runway, you either decide to cut and get to default alive, or you are default dead. Hiring and firing, bankruptcy laws are structurally favor American quick companies. The last 2 points, point number 6 is self-identity. Even though a lot of people think that Americans work harder, as you can see on this chart, America's the blue line. This is hours worked per year. America's just slightly above the OECD average. And yes, there are some large outliers, our neighbors outside of Luxembourg on either side, on the left-hand side, whose names I won't say, that probably could benefit from slightly longer hours. But there are lots of European countries, Estonia, Lithuania, Latvia, Poland, large countries included, that work many more hours than Americans. But Americans self-identify with their work. We do bring it home, I won't lie. We are proud of the work we do and proud of the association that we have from our colleagues. And it is a question of living as work and not work versus life. Which brings me to my final point that wraps this all up. Portfolio construction. As part of every financier's education, you learn about the efficient frontier, about picking an angle and then investing along that risk-return angle, finding your tangent with your efficient frontier. What I repeatedly see after having the backdrop that we see, some of the other capital mechanisms that we see, a smaller capital market, a more fragmented capital market, is that there isn't the kind of broad-based understanding of following the laws of investing, which is picking your point on the curve and developing a mathematically sound and diversified portfolio across that approach. Rather, we see many, many asset allocators artificially truncating at some random point this curve and only investing in the back half, the safe half, and then wondering, why did I underperform? Which gets me to my one last point, which is that I encourage you all to focus on the exception and the exceptional and find harmony with serving the median.